Good morning, ladies and gentlemen. My name is Chen, and I work for PRI as the Owner Insights team. Please take a seat, please. Thank you. The PRI as Owner team initiated a discussion paper to tackle the subject about how we do the ESG integrations into the passive investments. So here I'm going to spend 5 or 7 minutes today to update our progress at the moment, and I'll leave the conversation of the panel speakers today later on. Okay? So this paper is currently drafted in the version 6, and is aimed to be ready in the 4th quarter this year. This paper is contributed by 16 working group members, namely the passive investors such as GPIF, CalSTRS, AP1, AP7, and UTOM, as well as passive managers, State Street, Vanguard, Deutsche Bank Asset Management, and also index provider, the FTSE Russells and MSCI. So the discussion paper is aimed for the 3 objectives. The first one is to rectify the misconceptions that the passive investments cannot be responsible investors. The second objective is to investigate how the incorporation of ESG can be achieved through the investment decision process as well as the active ownership. The last objective of this paper is to share the potential solutions and the challenges or barriers that the current investor encountered. We hope that discussion paper can be a good start to raise awareness of ESG into the passive investments, and also to open a dynamic dialogue, a feedback innovation conversation within investment communities and on how we can do better in this remit. So perhaps before we start, I would like to define what do we mean by passive investment in this paper. So here, we define the passive investments as all forms of rule-based portfolio constructions that do not require any discretionary active stock-picking approach, but do the regular portfolio rebalancings on annual, semi-annual, quarterly, even monthly basis that do not include the high-frequency quantitative funds. So therefore, the passive investment include the plain vanilla market cap weighted index, the ESG integrated one, market cap index, and also alternative beta. By definition, we say the smart beta, factor investing that do not require any active investments, stock picking on that. In the level of the asset classes, given the fact that more than 60% of the assets are clustered into the listed equities, so this paper, we started working on the equities, and then we work on the fixed income at a later stage. So next, when we talk about the first objective misconceptions, to rectify that, we do believe there's compatibilities between the passive investors as well as the responsible investors through either the active ownership or through the investment process. The current professional investors who incorporate ESG into the investment process intend to achieve the enhanced financial returns and reduce the risk management, identical to the active investments, but also they would like to align for their the strategies that is with priority of the beneficiary. We know that a lot of asset owners or asset investors, they have been incorporating ESG into the active investments across asset classes for decades, but the passive investments of allocation of the portfolio still remain a gray area for them to incorporate, given the complexity or constraints of resource, etc. Some of the advanced the asset owners have been incorporated to ensure that 100% of their entire portfolio are actually ESG compliant, and in order to responsible for their beneficiary underlying. And meanwhile, there are other asset owners who incorporate active ownership into passive investments because they consider passive investment as opportunities to systematically drive the market transparencies further. We're talking about investing hundreds or thousands of stocks of the portfolio. So they do believe that within the investment horizon, the medium long term, they can gradually drive the market transparency gradually. Now, some investors also consider these opportunities to cope with systematic challenges. For example, there's burning issues on the climate change related topics. They want to align with the 2-degree Paris Agreement. So they use the passive portfolio constructions, passive investments to be aligned to decarbonize, so 50% or X percentage to align with the challenges. And some other investors also use these opportunities to demonstrate its stewardship in the local markets. For example, the GPIF, they has been recently moved to ESG market cap weighting index. This move has been increased incentive for the investee companies to improve their assessment of score by the providers, but also send a very clear message to the markets in the investment managers as well as the service provider about their commitment going forward. So now, having clarified the misconceptions of the passive investments, how do we incorporate ESG into the passive? We mentioned about the two approach through the investment process, which is principle 1, or through the active ownership through the principle 2. So in the level of active ownership, PRA has been published a paper on the practical guidance on active ownership in listed equities. So my former colleague Valeria did a great job. I strongly encourage any of you can have a look at the details. And in the level of the investment process, there have been many of ESG-related index in the markets through different data sets, through different methodologies, through different implementation approaches. Some sophisticated investors use multiple approaches to ensure that the passive investments align with the ESG goals. For example, in the paper, we mentioned about FRR, the French public pension funds, who use 4 layers: exclusion of tobacco, exclusion of the coal assets, and decarbonization of the whole portfolio by 50%. And last layer is actually using ESG integration on that, which results to the 1% of tracking error against the benchmark, and the FR is comfortable with, given the fact their investment horizon is longer, and also their determination in ESG goals. So we share many case studies just to share. There are many of the asset owners on the ground working very hard to incorporate ESG into the passive investments. And we hope that we can really start to embark a lot of conversations going forward to raise awareness on that. So lastly, we are not suggesting that incorporating ESG into the investments is passive is anyway straightforward without challenges. So in the paper of the draft, we mentioned about 3 types of the challenges. I wouldn't go through much details, but I just give you some flavor on that. On the data related, you might know there are some issues in the data, and some investors on the ground now, they consider some data too much backward looking. They consider looking for something forward looking data. And AP1 could be probably one of the examples who really allocate part of their equity portfolio to the strategies who use ESG data, which is much more real time, and we call it artificial intelligence, in order to capture the financial returns and also in order to align with their ESG goals. In terms of portfolio related, we know that when you make a switch from the plain market cap weighted index to ESG, there might be some unintended consequences going forward. And we share a couple of case studies to discuss how the investors did the analysis of pros and cons to understand what's the switch, and also the rationale, how they actually justify the switch to in line with the ESG goals. Lastly, the engagement-related challenges. We also share a couple of case studies about how innovative approach where asset owners work together with investment managers. For example, the HSBC UK pension scheme, who gave the extra tracking error budget, 30 bips tracking error budget, to their external managers, legal in general, as options to divest the companies in the benchmark if the company didn't deliver a proper, the corporate solution strategies on the climate-related changes. So, again, I wouldn't cover too much. I'll leave the floor to the panel speakers. And I just want to say this paper as an initial stage to open the conversations in the hope that we can have much more feedback and also the innovative approach going forward. We are hoping to shape in the guidance going forward whenever the market is ready. And I'll leave the floor to the Brian Rice, who is moderator.
Thank you, Catherine. Thank you, everybody, for choosing to be at our panel. I think we've got a good panel for you. I know there's a lot of moderator hubris around how good their panels are. but in this case it's true. When you consider the theme of the panel, integrating ESG into passive investments, the panel is represented by, in my case, CalSTRS, a very large public equity, very large passive public equity investor. I'm joined by Majdi Chammas from AP1 in Sweden, certainly leaders in ESG integration. To his left is Jessica Huang, representing BlackRock. Nathalie Wallace, representing State Street Global Investors, two of the largest asset managers in the world. And then last, but certainly not least, representing MSCI, we have Nishikawa. So in the presentation that Catherine gave to you, there were sort of two components as I saw it to integrating ESG and passive investment. One was in the construction process of the index, and the other one was sort of an overlay or engagement on top of an index. So we'll try to touch on both of those as we go along. I first want to focus sort of on the index construction side and give you some background on CalSTRS. So we are the retirement system for California's public school teachers. We have about $225 billion in assets under management. We have about 990,000 plan participants. We are mostly public equity. It's about 55% of our total portfolio. Most of that is passive, I'd say roughly 60%. So a third of our total portfolio is invested in a mostly cap-weighted index manner. We have chosen to overlay a very robust engagement strategy. That's how we choose to integrate ESG into that exposure. We engage companies on a variety of environmental, social, and governance issues. And certainly our proxy voting integrates ESG and supplements and our engagement. We have recently taken a step into the ESG-themed space. We committed $2.5 billion to a low-carbon index. The U.S. component of that has been invested for a little over a year. The expectation is by the end of the year, the non-U.S. developed markets will be invested, and then we'll have a emerging market component shortly thereafter. So with that, as I said, I wanted to turn first to Majdi. Maybe you could describe your role at AP1 and how you approach passive investment and then the role of ESG integration into that strategy.
Yeah, so I'm responsible for the external management team at AP1, all listed and equities and fixed income. And we have a big portion of our, especially emerging markets allocation, which is dedicated to passive investment because we need that for liquidity reason, and we need that because of the cost pressure that we are under as a public pension fund. And for a long time, it's been a challenge for us because every time we have any controversy in the portfolio, any company that is doing bad in terms of sustainability, we are scrutinized and asked, why do you invest in those companies? It always shows up in our passive book of business. 2 years ago, we launched a project with the aim to find a solution for this. And most of the things we were approached by was more kind of indices, ESG indices, low carbon indices, whatever you think. We didn't feel that is enough. And one of the challenges everybody was talking about, we don't have any data. There's a lack of disclosure. The data is not there, especially not in emerging markets. But we continued to talk with managers and had dialogues with them and try to find a solution for that issue. Because data is something that is abundant today. We have a lot of information out, but you need to find it in the right place.
So what percentage of your equity allocation is passive?
Today we have about, in emerging markets, it's half of our exposure that is in the passive. Roughly it's about $2 billion in
So you're only passive in emerging markets?
Yes.
Okay, very good. So now maybe we can hear from Jessica. I mean, BlackRock's got about $6 trillion in assets under management. I think it's about 340 equity index funds. Maybe you could talk about your role at BlackRock and how BlackRock approaches ESG integration into its indexed strategies.
Great, thanks. Hi everyone, Jessica Huang. I'm part of the BlackRock Sustainable Investing team. We are the central team at BlackRock that really partners with all the different investment teams, all the different product teams, as well as the distribution teams to create new and innovative solutions for our clients. Really, our team focuses on ESG research, ESG integration, as well as the development of solutions. Specifically within my role, I focus on solutions, and so prior to even joining the Sustainable Investing team, I came from the iShares business where I designed and built all the sustainable ETFs that we've launched over the past few years. And really my background has really been in product design. And really at BlackRock, when we think about integration into passive or integration really into index-based solutions, we really think about it from our stewardship and our engagement approach, because the index solutions that we offer are designed by third-party index providers where we don't tell them, which companies to add into your index. And so ultimately, as a fiduciary, it's our job to really engage with the companies that are in the index that we invest in. But really, beyond the ESG integration and the engagement part, which I'm sure we'll get to a bit later as well, we offer choice. So as an asset manager, the money that we manage is not ours, the money is for our clients. And so it's our job to design the best products, offer the best choice for all of our clients. And really that's what we offer within the sustainable platform, which at the moment is about 500 billion in AUM, although I will say 90% of that is in screened assets. So really we have 50 billion in dedicated ESG, thematic, and impact solutions. And within that 50 billion, about 40% is in index-based ESG, thematic, or impact.
Okay, thank you. So Nathalie, maybe a little bit of compare and contrast. I mean, please tell the audience your role at State Street and how does State Street approach integrating ESG in its passive products?
Absolutely, thank you, Ryan. So I'm the head of ESG investment strategy at State Street Global Advisors. My role is, along Catherine a bit, my role is to coordinate between the ESG research, the portfolio management teams, and the business development teams. So really trying to understand how we can implement rule-based product and solution to address climate risks and ESG integration challenges that our clients face. A bit of a contrast maybe is we are at State Street combining both asset stewardship and ESG investment under the leadership of Raki Kumar, so we are an integrated team. We work in tandem and we are in the process of integrating the ESG or the stewardship scorecard into our proprietary ESG scores, and we can talk about that later. So, but that's something that is paramount of what we do. We are, as Catherine said, Jessica said, we are long-term investors with responsibility for stewardship, and we approach stewardship as a risk-adjusted return factor. So we are focusing on the underperformers, on climate, on many ESG issues and diversity. Okay, all right. And we integrate, as I said, our stewardship into our investment principle and decision making.
Can
you start?
we just do a
Sound check.
I think there's some issue with the microphone.
Is my microphone higher?
No?
Is that better? No? Is that better? Louder, okay. So I'll go briefly on how we integrate ESG. Stewardship is a big part. What we are launching into as well is 3 pillars, which is ESG integration, climate solution, and SDGs. We have built out an infrastructure of 9 data providers. So the core, this is a core foundation for us to really build investment solution analytical tools for our PM, as well as reporting for our clients. Beside that, for the investment solution, we're really focusing on transparency. So the way we are building the ESG scores is by using a materiality map that has been produced by SASB. It's a materiality map that is vetted by the companies in different industries, vetted by investors, and it's transparent. It is on their it is on their website, so everybody can access it. So it has also academically been proven that it can add some alpha. So we're looking at bringing transparency through our index products here. The second is building climate solution, and we mentioned it, Majdi mentioned it, that are Paris compliant, meaning that we have adaptation metrics in it, but as well as adaptation metrics, meaning that these companies will be measured on their preparedness to face the physical impact of climate change.
So thank you, Nathalie. Now, you talked about you're doing your own scoring. Is that going to create indexes?
That's right.
So you're creating your own internally as opposed to BlackRock, where you're utilizing other index providers.
Yes, at the moment, although BlackRock, we do have the capabilities now to self-index, and with my team, we are growing out a research function as well, which similarly is using multiple data sources to come out with proprietary views on ESG, whether it's the broad ESG, whether it's climate specific, whether it's thematic or cross-inclusion diversity issues, or even just governance. And similarly, while my team is completely separate from the stewardship team, sorry, I hope that's not me, but and I don't know what I'm doing to cause it, but really our two teams are separate for a good reason, but we are using our stewardship team really to tap into their governance expertise and using that information more and more for the design of our solutions as well.
Okay, thank you. So now I'd like to turn to Laura. MSCI has a number of ESG themed indexes. Maybe you could talk about your role at MSCI and that, and how you're looking at integrating ESG into your index products.
Sure, I would like to. Can everyone hear me through this mic, or do I use this mic? And someone can. This one?
Turn these off.
Okay. Can you hear me now? Good. Hopefully this one doesn't scream. So I'm at MSCI. I've been there for about 11 years. Done a lot of different roles since then. I've worked on the development of the MSCI, Bloomberg Barclays MSCI ESG fixed income indexes, but right now I run a team of about 50 people globally, our senior analysts who are focused on doing the research on industries, on themes like climate, governance, but also developing the methodologies and the models that feed into our ESG indexes on both the equity and the fixed income side. So I'll talk a little bit about the trends that we're seeing in ESG and passive. We work with asset owners globally, of course, but also a lot of asset managers in terms of developing products. And we do see a very strong growth, and I think that growth will continue in terms of demand for ESG integrated passive solutions. Right now, I think we're a little over $125 billion in assets passively tracking ESG indexes from MSCI, and that continues to grow. Every day. We're seeing the demand coming from very different places. So I think, as Majdi mentioned, we do see a lot of asset owners on the institutional side who maybe have very strong ESG integration practices with their active mandates, but those could actually be, fought against in terms of their passive allocations. They might have names in there or exposures in there that are contradicting what their broader goals are. So as we see increasing adoption of ESG at the policy level, in some cases at the policy benchmark level, we see a push towards integrating ESG across active, factor, and passive mandates across the broader equity program and increasingly in fixed income. But then on the flip side, we see on the retail side as well a lot of interest in gaining some ESG exposures. So we see a lot more product creation, particularly in the US, but also in Europe and in other regions on that side as well. So in terms of not just growth that we see in terms of who's looking at ESG passive allocations, we see a big change in how we're doing it as well, and I think maybe we'll get into some of the details, hopefully, around this. But essentially, we've seen passive being one way to gain rules-based systematic exposure to ESG factors that are in line with the broader investment objectives. So I think we've moved very far from, black and white, either you're market cap weighted and you engage, or you have a passive or index-based solution that screens out whole sectors and takes unintended risks. We've gotten much, much further along in terms of finding ways to marry the investment objectives and the ESG objectives, and that could be through low tracking options, for example. So investors who don't want to take too much tracking risk, but want to enhance their ESG exposures or their carbon exposures. We see differences in regions, so maybe that might be the baby steps in one region. In other regions in Europe, for example, we see a lot more willingness to take a tracking error budget, in which case we're seeing a lot of tilting approaches and reweighting approaches, as well as looking at approaches that are focused on the leaders in each sector, which might be able to provide some risk mitigation, some downside protection, and achieve other benefits. And then finally, I guess lastly, we see a lot of demand for combining ESG strategies with ESG approaches with factor-based or other rules-based strategies. So looking at ESG and value, ESG and momentum, ESG and multiple factors. So we've seen a huge change in the sophistication of these kinds of approaches, and I think we're going to continue to see a lot more kind of tailoring of approaches that marry both the broader ESG objectives with the short-term investment objectives.
Okay, great. Thank you for that. So I want to turn back to you, Majdi, and maybe for the panel, start some of the challenges around more broader adoption of ESG and passive strategies. And going back to what I sort of said about CalSTRS, while we have made this investment in a low carbon index, we are still majority cap weighted. We talked about sort of rules-based approach. It can still be passive as long as there's a rules-based approach. And I guess when we think about ESG, some of the concerns is with all the sort of rules out there, what if you're going to take that step into ESG more broadly, what sort of rules do you follow? And then the data we're seen as somewhat inconsistent, and that seems to support these rules, so there's another concern there. Unintended biases. So if I'm an investor with those sorts of concerns, what would you say to me about comforting me about embracing more of a ESG integration strategy?
I think you have to go back one step and think about what is passive and why are you investing in a passive solution from the beginning. Because in my belief, we need passive for different reasons. One is, as I said, liquidity. One is for the low cost. And we would like to have the market return from a certain market that we're investing in. And when it comes to choosing different approaches, I think it's the same way when you decide to use, for example, the MSCI market cap indices as your starting point. That is the biggest decision. And this is the decision that you have to come to approach. If you take the low carbon, if that is the most important thing for you as an asset owner, then low carbon is the one you should choose. For us, it was never the case because we wanted to make good ESG investments across all aspects of it, not only carbon or water, whatever it is. So the first decision is to feel comfort that you can deviate from the benchmark, because who says that that is the right starting point? The MSCI market cap indices or FTSE or Russell or whoever it is. So that's, in my point of view, is the biggest decision you have to make, and feel comfort by deviating, and deviating in the right direction, we believe is good. And this is why we feel comfortable about this approach, is that if you move into more sustainable investment, you should do good in the long run. And so it's two things. You have to deviate from the market cap indices and also allow yourself to be more of a long-term investor. If you're going to chase the quarter results, half-year results, yearly results, it could be a challenge. But I believe that we should shift away from the starting point. This is our risk-free starting point.
So I'm willing to accept a new set of rules. In your case, how did you then shift to that sort of ESG rules-based approach?
So for us, it was very important that the strategy that we are using is having unique set of information, not relying on already existing data, because MSCI or Truecost or Sustainalytics, they have the data they are relying on is lagging. So for us, it was very important to have a strategy that is relying on more real-time data, more unique data, because if you're doing what everybody else is doing in the market, you're not outperforming. You're getting the market.
So staying with the theme of challenges, maybe, Jessica, what do you see in terms of challenges around uptake in ESG products?
Sure. Can everybody hear me okay? I think you should take this. So in terms of challenges, I guess before even diving into challenges, I think it's good to reflect on how relatively new ESG and indexing is relative to ESG investing more broadly. When you look at this space, and especially with the increase of ESG indices, most of these indices were incepted 5, maybe 10 years ago at the most. There are some very long dated indices out there, but it's very, very few. But generally all of the ESG indices that we've seen over the past 5, 10 years, really, that's when it started. And so I would say that this is still a pretty new space within ESG, but a lot of area of good growth. So recently my team had to do a lot of competitive landscape overviews, and so we're doing a deep dive into what is the breakout of index versus active within ESG mutual funds and ETFs. And today, really, the breakout is that 80 to 90% of the assets within the mutual fund and ETF space across Europe and the US is still in actively managed strategies, meaning that 10%, at most 20% is in index. However, when we looked at the growth, we're really looking at the 5-year CAGR, what we saw was sustainable indices, the sustainable index-based strategies were growing at 2x the clip of the traditional index-based strategies. And then within looking at the entire space of sustainable funds, the passive, the index strategies were growing much faster. So what we're seeing is more adoption within the sustainable index space. Now there are a lot of challenges, and data quality is the biggest challenge, because when you're investing in an index-based solutions, as Majdi was talking about, it is rules-based, it is systematic, meaning that you can't fundamentally disagree with what's in the index. If it's in the index, you hold it. And so from that point of view, everything we rely on is good data. The good thing is that data is improving, companies are reporting more, and at the same time, technology is improving, allowing us to access and synthesize data in more of a real-time manner. So definitely moving in the right direction, although there's definitely still challenges. The other challenge that we see with index-based solutions, and I would say particularly this is a challenge we see within the retail and the wealth space, is that clients are expecting better reporting. Now, when you have a fundamental strategy, it's easy to have those great anecdotal stories about the companies that you invest in. When you're investing in an index strategy, it's just not the same. And so coming out with this portfolio level, index level type of reporting that resonates with end investors is something that I think everybody's trying to work on to get better. When you tell a client, oh, just so you know, your portfolio index has moved from an ESG score of a 5 to a 7, my parents would have no idea what that means. And so from our point of view, we're trying to figure out how do we get to the end investors to explain what ESG means inside their entire portfolio.
Thank you for that. Nathalie, so what are you seeing State Street in terms of challenges to greater growth in passive ESG?
Yeah, so it's a good question, and I would like to follow up on some of Jessica's points. We spent the last 18 months to 2 years starting from a clean slate and reviewing all data providers out there. Deep due diligence, understanding how the raw metrics were prepared, and understanding how the scores were constructed. And that's actually two different, very important steps in how ESG scores are built. Estimates on carbon emission for a company, because the company is not reporting, is made differently or produced differently depending on the data provider. So right there already you could have major differences. So again, to Jessica's point, if you build an index, end product, you have to understand how the carbon emission metrics that you are going to report on is built. The second point, as I mentioned earlier, is ESG scoring. And what metrics are you going to use for that company in that sector specifically? Which one is financially material for risk-adjusted return? Then we are talking about, yet again, risk-adjusted return for a rules-based investment solution. We want to be transparent. We want to align as much as possible our solution to capital market changing standards, if you will. And that's why we are, we have chosen SASB as our major maturity map provider. So that's the 2 point. All of that, this infrastructure is necessary to build investment solutions that are adapted and transparent, where investors, asset owners, can understand when I invest in this, that's what I get. That's the reporting I can get, and I understand how that data has been run and how this score has been produced. And also align with, more aligned with the targets that we're all facing with the Paris Agreement. The second point I want to say on challenges is, yes, this adoption, and adoption of, or the first step. What is the first step you should take as an asset owner or an investor when you want to adapt or have a climate that is climate resilient and adapt your portfolio to future targets? We've seen clients saying, so what we are offering, what we're trying to work with client on is flexibility. Do you want to go right away to 70% reduction of carbon emission with some investment consideration, like tracking error? Or do you want to dial up, meaning minus 10% this year, 20% next year? So investment solution and portfolio construction have to be flexible to be integrating this dial in or dial up metrics in the system. We see, obviously, I would say the smart beta or multi-factor approach has been a precursor in adding an ESG factor or climate factor. So it's an easier conversation. But I would say, again, mentioning Europe and US, in Europe we see a lot of, I would say, more aggressive demand to really target aggressive carbon reduction, social metrics, diversity, and we are, happy to act on that. The other thing I wanted to mention is we are building for our portfolio managers interactive tools. So it's not just an ESG report or a climate report with water stress and where are the water stress map in their portfolio. It's really digging into each sector, digging into that segment of the market. What are the analysts saying on that specific stock? What is your controversy score? What is our engagement on this portfolio? Where do we see impact? So it's really having an interactive conversation for the portfolio managers, the analysts as a team, and also being able to translate, as Jessica said, that to clients and say that's really where we see your risk, the risk in your portfolio from a carbon emission perspective, from an ESG, from a social perspective, or a controversial stock perspective.
Thank you. So I want to, Laura, as talk about performance. I mean, as an investor perspective, that's what we're, key to us is performance. And I think, Jessica, you talked about indexes, maybe 5-10 year history. So there's you have some performance history. Or I guess the question is, are these indexes performing sort of in line with expectations?
Sure, and I'm glad you asked that because I could talk about data all day, but I'd love not to. But I think a lot of this does come down to data, right? So a lot of our ESG ratings, our ESG data, we have it now about a 10, 11 year history that's clean, a rougher history that goes a little further back. We have some indexes with a longer track record. So that really allows us to start understanding much better what are the performance implications, what are the risk implications, can we build better strategies? And I do think the data has a long ways to improve, but it has improved and it continues to improve quite dramatically. So in terms of performance, it really depends on what you're talking about, what strategies you're talking about. So for example, we do have a lot of clients who opt for, a optimized low tracking approach, which have performed in line with their objectives, which is essentially low tracking error, very market-like performance, broad market exposure, but with better ESG or with better lower carbon. And those really aren't seeking to outperform, and they've done what they've been expected to do. But some of the other strategies, for example, our ESG Leaders Suite, which is looking at the top 50% from an ESG perspective in each sector, have shown very different results in different regions, and I think that's actually quite interesting. So there's a very strong performance story in emerging markets, for example, that also seems to be driven a little bit by the leaders, whereas in a lot of developed markets like Europe, they track the market quite similarly in terms of performance, or have in the last 10 years, but with reduced risk, and we really see a kind of downside risk reduction by excluding those laggards. So I think it's really important to understand what you're getting into, what you're doing, and I think now that we have more history, more data, and we've been able to dig much deeper into this, earlier this year we produced a 4-part series called the Foundations of Esg Investing, so if anyone wants to dig into the numbers, they're there. We're starting to understand much better what are those implications. And in generally, and I know this is preaching to the choir, but there's very rarely a drag on performance. If anything, there's an enhancement of performance, a reduction of risk, or market-like exposure with better ESG.
Thank you. So I did mention we would talk at least a little bit about the engagement overlay to indexes. So I want to pivot to that now. And I guess the broad question is considering BlackRock and State Street, how large your portfolios are, how do you choose what issues to focus on, and how you try to sort of ensure that you cover, there's enough of an umbrella of engagement across your portfolio to really be integrating ESG?
Sure. So at BlackRock, being the largest asset manager, we also have the largest stewardship team. So we have a team of close to 40 individuals, and for those of you who read Larry Fink's annual CEO letter this year, he committed to doubling that team in the next few years, so it should be a team of about 75 globally. And really, this is the team that day in and day out, they are engaging with all the companies that we invest in. And while they can't actually physically meet with every single company, nor is there need to, they do have over 2,000 meetings a year, and they vote at over 17,000 different meetings as well. And so ultimately, this team has outlined their ESG engagement priorities for 2018, where they've outlined 5 key ESG issues that they'll be engaging across the different portfolio companies that we invest in. Those issues are governance, human capital management, climate disclosure, executive compensation, as well as long-term corporate strategy. And in general, this team takes an engagement approach first, where we are patient, and we will work with the different companies that we invest in over years at times, but we are not infinitely patient. And so a question that we get all the time is, how do you measure your success of engagement? And that is extremely difficult. And the answer I'm going to give is, how can you measure when engagement's not working, which is really when we vote against the board of directors, or when we vote against what management is expecting. And really that for us is a sign of failed engagement. And ultimately, the way that we decide on the different ESG priorities to engage upon is really based off materiality. What are the issues that impact businesses the most over the long term? Those are the issues that we will be engaging with corporations on.
Thank you. Nathalie, could you share your approach?
Yeah, absolutely. So as we said, and our CEO at State Street Global Advisors, as well as the CEO of State Street Corporation, have said we are long-term stewards here. So index funds must be activists to serve investors. What we're looking for is to improve companies' performance, to translate into stocks and bonds, improved risk-adjusted returns. For that purpose, again, we use our data infrastructure to assess and identify underperformers in each of the different categories that are well known. And I would encourage you to go to our website, download our latest annual stewardship report, where we have all the impact data, measuring how we have done and how we're doing and engaging in terms of framework, guidelines. We are very transparent with the management on what we are expecting. We are co-founder of the Investor Stewardship Group for the U.S. market, where we are very, really providing guidelines, general guidelines, but specifically we are very transparent with what we're expecting and what change we're expecting on disclosure, on diversity on boards, on many issues that Jessica has eloquently talked about. But we also, by being transparent and speaking softly, we carry a big stick and we vote against management when necessary. I'll just give you an example. We started our campaign, Fearless Girl, in 2017. We met with more than 700 companies specifically on that. We voted against 500 plus companies in 2017, the proxy season of 2017, and we had an impact of 152 companies where they implemented put in place a one female on board, plus 34 additional who committed to do it. So this is the kind of impact we want to see. We have a general tendency of saying, 3 years to give enough time to the company to implement the changes, but we've shown that we can vote with an act to make sure that these guidelines are implemented.
I'm just going to jump in really quickly. We don't do engagement, and you guys are definitely the experts in this area. And I don't think this necessarily replaces, maybe it complements engagement. But one thing that we have seen that was a little bit of a surprise to me in the last 5 years, as we've seen more index-based strategies come up, is the signaling power of an index, both in terms of signaling to the broader market in a rules-based way what those objectives are, what those criteria are, but also signaling to companies. So it's been really impressive, particularly in markets where ESG was less developed. I'm thinking in Asia and Japan, where an influential asset owner has shifted to an ESG index-based strategy, which just clearly, transparently delineates the rules of what you need to do as a company to get in and to get out. And it's changed the conversation we have with companies to such an extent that we've actually had to hire a team of people to manage just the back and forth with companies since that allocation was made. So I think sometimes we forget about that aspect of signaling through deciding those rules, deciding not to follow the market cap weighted approach, can actually have some engagement outcomes maybe that complement some of the other activities.
Thank you for sharing that. So I want to be mindful of time and open it up to audience questions. I believe there's some microphones. We have to give up our microphones. So maybe we can start in the front, right here.
Thank you. Can you hear me? Son, can you hear me?
Yes. Now.
Thank you very much. I think this is one of the, David Harris from FTSE Russell. I think this is one of the most exciting parts of the investment landscape, and we've seen, I guess, this huge rise of initially focus on smart beta and allocations to factor index funds, and now what we're seeing is this rise of ESG index funds as well. And what I think is particularly exciting is that coming together. So when you think about what does ESG integration mean for passive, then bringing it alongside factors, it seems a very appropriate way of doing it and using the same philosophy and mechanisms to do that. And so we now actually see that the majority of new mandates, which are smart beta focused, are wanting to incorporate climate or other ESG parameters alongside it, which is incredibly exciting. That's happened very quickly. But my question is about this link between ESG index design and stewardship. So there's been some kind of mentions around GPIF and what they aim to achieve, but very much part of it seems to be about wanting to engage companies across a whole market through baking those ESG standards into the index design, and using that as an effective way to engage a whole market. So my question, I guess, particularly maybe for the asset managers, for Jessica and for Catherine, is do you see in the future a link between that kind of stewardship and engagement work and linking it into some of your specific ESG and climate index funds?
Sure. So in the sense that you're saying that the topics that we engage on would be incorporated in the ESG indices that we.
But if a company could only be included, for example, or overweighted in an index,
Got it.
so that falls to some of these areas.
I think you should just.
I think that goes to what you were saying in terms of the signaling that the ESG.
Well, and so, if I may, that's what we are doing. So we are integrating stewardship and ESG investments from a team perspective, but that means much more in the sense that, as I said, the data infrastructure is the same. So we're integrating, the methodology is the same in terms of ESG score specifically, different from climate. In the ESG score, we are, yes, working to integrate our scorecard driven by our analysts and interacting with company into our scoring. And thus, that score will be driving a capital allocation, right, from an index perspective at the end of the process, of a long process, right? But portfolio construction will take either a multi-factor plus ESG approach or a full integration of ESG. And that ESG score will integrate our own, a weight, some of the weight will integrate our own stewardship. Impact and scorecard and what we see in terms of change. And I think that's actually, that's innovation, and that's very important for capital allocation in the future, not only based on best in class, but where you see change, where you see potential, a future signal for alpha for us, but also improving performance for companies and hopefully capital markets, yes.
Yeah, and just to add to that, at BlackRock, at the moment, we haven't created any of our own indices, but as we move down the path of creating BlackRock ESG indices, it's going to be extremely important for us to use the insights of our stewardship team, because that's exactly what they do, is that they're measuring and evaluating these companies based off of ESG material issues and governance issues in particular. And so from our perspective, it would be a waste not to use the insights that they're also working on. And we've already started actually creating some actively managed strategies that incorporate more of the insights from our stewardship team as well.
Mike Clark, our advisory, Majdi's comments earlier made me think of an issue I hadn't really spent much time on, and it actually ties in a little bit with the last comment. So this is really a question for the asset owners. As you begin to specify your desired risk exposures more clearly, your SDG comments, your low carbon, and I think it's a market structure question, will you require your investment managers to effectively become ESG data providers? Because the question becomes a bit more about portfolio construction. Indices get slightly parked, they're a bit more FYI, but what you're really interested in is the portfolio construction to your specification. So your supplier needs to respond almost one-on-one to the asset owner needs. Do you see that as something that's in your mind when you're looking at the market?
I mean, so certainly we're expecting our external managers to be focused on ESG risks and to be reporting on it. And we look to partner with our managers in terms of the risk exposures that we see and the engagements that we do. I wouldn't say we would ever require that, but I definitely see it becoming that they are now providers of information to us, and I would imagine going forward they would become greater providers of information. I mean, they're out there, meeting with lots of companies. They're in the markets. They have a little bit deeper understanding maybe, and so wanting to, as I said, tap into that.
And I would agree on the reporting. This is very important for us because that's the feedback loop for us. We have to report then to our stakeholders what we are doing. So absolutely, this is a requirement. And we've had some dialogues already now with BlackRock in that sense, how we can get reporting that is relevant and showing what we are doing.
Hi. Is this on? Can you hear me? Morgan Collins, Starbucks. Thank you for being here today. I'm actually really excited about passive investment, being a millennial and realizing that a lot of millennials have kind of grown up in this just go low fee, go passive. And so I think it's actually a huge sector of continued growth. But because I'm a millennial and because we all like to ask a bunch of annoying questions on transparency, I would love to know what is currently the biggest block in effectively conveying what is going on in a portfolio from an ESG perspective, because reporting as it exists today just doesn't satisfy, I think, a lot of the real questions on how is my money being invested, and then in your view, and it could be your personal view, not even the firm line, how should companies, investment managers, be effectively conveying what is going on in a portfolio in a way that actually gives transparency and relevant information?
You can go here. Sure. So I'll go after. Okay. Just quickly, I mean, this is something that we've been thinking about and talking about for so long with many of our clients, and there's just a few issues in terms of when you think about portfolio reporting, right? Because ESG materiality is so dependent on the specific company, the specific industry. So when you start to aggregate up these metrics to portfolio levels, sometimes some of these data points are only relevant for 20% of your portfolio, maybe 50%. There's some specific metrics such as carbon emissions that could be relevant for much more of your portfolio. And so where we can actually translate to more of these tangible outcomes, whether it's translating your emissions reductions to miles driven by a passenger vehicle or carbon sequestered, that's where we're trying to do a better job. Things like board diversity, where data is accessible and reported on, we can report better on those things. But a lot of the ESG metrics that we do rely on are just not aggregated on a portfolio level, and so we do want to be as intellectually honest as possible and clear as how we're reporting. And so there's definitely room for improvement, because part of the issue is just the fact that companies don't report on a lot of these underlying issues to begin with, so the starting point is a little bit messy, but it's an area that we're actively working on and hopefully getting better at.
Yeah, I'm just going to echo a little bit of that. We're working on this with a lot of the larger wealth platforms, with a lot of the asset managers, a lot of the asset owners. I think the transparency question is key to all of this. Definitely it has a lot of room to improve. I would say, I know we complain a lot about data, and there's a lot of places where there's not enough data. When I work on a lot of these reporting projects, it's almost like there's too much data. There's not enough meaningful data, but there's too much noise. These issues are very complex. They're very industry specific. It's just too much for someone to handle. So I think there's a lot of room to really nail it down into what's more meaningful, and particularly I think in the wealth and retail space, we see millennials, we see all generations looking for low-cost exposure to broad market with that's maybe a bit more meaningful, and so to connect those dots, I think, is something that we all have kind of a shared interest in doing.
And also in terms of transparency and data, I mean, we need always to have comfort from the managers that they're doing the right things. So they need to be transparent, but also we need to be transparent to our stakeholders, because that's where we create a confidence. And this industry is about confidence. You have to, rely on people managing your money. We have to rely on investment managers investing our money. So we have to keep this chain of trust intact, and that we can do by being transparent and, as much as possible, give information backwards.
I'll be brief. I want to make 3 points. I'm going to sound like a broken record, but transparency starts with data at the origin and how the ESG scores or the metrics are constructed to get an output that is understandable, right? So that's the first thing I would say. So having, again, the SASB maturity map into a reporting framework, I think is critical. I think everybody, I think that's a big game changer in capital markets. The second point is I want to mention 2 different request or innovation we're working on with clients. One is for beneficiaries, which is, let's call it millennial, but also others, where we have to translate financial information or reporting into, I would say, more common sense and less financial oriented narrative, if you will. So yes, number of miles or tree, how many of trees did you not cut today by investing in this stock? So that's the communication issue more than a reporting. I think we have the reporting capabilities. It's just to translate that into common sense narrative. I think on the more financial literate clients, I think what is going to be important in the future? And we already had that kind of questions, and I think that was a question that was asked at the beginning of Smart Beta, which is, what's your ESG factor attribution? How much of this return is attributed to that factor, to this metrics? There's a lot of noise there. This is very much an uncharted territory at this point. We have to be very careful with that kind of risk attribution and performance attribution, but that's something that I would expect to be very much a big driver over the next few years. Sorry, so I extended versus your question, but.
No, wonderful, thank you so much.
Brian, is this on? Hello?
Yes.
Now it's on. Brian, it's Andrew Birmingham, Montreux Energy. You participated in a roundtable we did in California many years ago. My question's for Majdi. It's great to see you. I'm not sure how I get all the gray hair, right? I just linked in with you. I hope you link in back. So I come from the energy world, and specifically I come from hydrogen. We're talking about long-term investments. We're talking about passive versus active. I want to make a pitch to all of you, and Brian, I'll follow up with you so we get this done. But I'd like to do a study that looks at the exposure that all of your portfolio companies could have to hydrogen. And we don't talk about it every day, but there's another meeting called the Hydrogen Council across the street. And it's got all the major oil, gas, automotive companies talking about hydrogen. And you investors need to know about those companies if we're going to reduce carbon and have a cleaner planet. And that's why we're here. Just a quick thought, how can we put together a primer of where passive investors ought to be or could be in 5 years' time if looking at this one issue of hydrogen. So it's Andrew@hydrogen.com. Brian, look forward to seeing you.
Very good. I think we might have time for one more question.
Thanks. This is a bit of a follow-on from that. My name is Jeff Conant. I'm with Friends of the Earth. We're all here, obviously, because of the climate summit down the street. To get really concrete, BlackRock is the largest holder of oil, gas, and deforestation-driving commodities on planet Earth. You're obviously getting deeper into ESG, but at the same time, you're doubling your passive holdings over the next 3 to 4 years, as is State Street, as is the entire financial sector. We need to rapidly decarbonize the economy, right? What are you doing concretely to do that? Will BlackRock get out of oil, gas, and coal? Will State Street get out of oil, gas, and coal? What are you doing to get aggressive about deforestation? These are big questions. I doubt we have time to answer them, but to really get concrete about meeting the Paris goals, meeting the SDGs, how is passive investing going to play a role in this? Because it really needs to.
Sure, I mean, I can go first, and I assume my answer will be very similar to Nathalie's here, is just a reminder to everyone that as asset managers, the money is not ours, where we are fiduciaries on behalf of our clients. And to that end, really, where we can help, drive change is through engagement. And that's where we are asking companies to provide better disclosures when it comes to their climate risks. And this is, very, very important in particular for the oil and gas companies. And so earlier this year, we actually sent a letter out to, I believe, 300 different companies around addressing the climate disclosures along TCFD. And I believe we actually received responses from 160 of those 300 companies. So there is definitely progress being made in terms of better transparency. And then really the other area of focus is just our research and then our solutions, where we are going to offer, the best products that we can build with regards to moving towards a low carbon economy, towards a low carbon, towards this transition towards a low carbon economy, where my team's been doing a ton of work where it comes to measuring, physical risks and trying to address, which companies are actually at most risk where it comes to extreme weather events, and also addressing companies that are actually not prepared for the low carbon economy transition as well. And so from our perspective, it's really better data, better research, good engagement, and then ultimately better solutions that we help to offer so that investors can actually invest in long-term sustainable solutions?
I agree. I would suggest that we all move to Europe. And the reason is, as Jessica said, it has to come from asset owners. We are implementers and fiduciary stewards. That's what we are trying to accomplish. But from the development of new products, that capital allocation you are mentioning is happening or will happen. The demand is there from either top-down regulation from Europe, and I participate in the regulation consultation on how to implement really taxonomy, benchmark, decarbonization, transition, looking at scenario, physical risk. Any work on the top is important, but at the end of the day, we need the CalSTRS of the world and the AP of the world to really tell us we're ready to take that tracking error versus a benchmark that might not be a good benchmark, and capital allocation is happening. It will happen faster once we have that. In the US, it might take a bit longer. I stop here.
And I think a very important issue also to raise is that even policymakers need to do a lot more. And then we have to vote for the right people to do these choices.
So as moderator, I'll take make the final comment. And is it working for a pension fund that's been engaging major oil and gas companies for over a decade? There is progress being made, and I recognize the urgency and how many might believe it's not happening fast enough. But absent our and a lot of other investors' involvement in this issue, I doubt this level of progress would have been made. And I guess I want to point to Shell as the one example, who recently made a commitment to measure its carbon footprint from sort of life cycle, and then made a commitment to reduce that amount. And so again, progress is being made, and absent investors like the ones you see up here, I doubt that progress would be seen. So I want to thank you all for being here. Round of applause for my panelists, and I hope you enjoy the rest of the conference.